Hello, everyone. I'm Casey O'Rourke here at Fross and Fross Wealth Management. Today, I'd like to talk about what we saw in the markets in January and what the Fed chair news really meant. First and foremost, the stock market. January felt a bit like being on a bumpy road. Stocks moved up and down throughout the month and ended with modest weakness. There wasn't a big fall, but there also wasn't a strong rally to speak of. Technology stocks, in particular, pulled back some. The chatter around interest rates and economic headlines kept investors cautious. Now let's talk about the Fed chair news. At the end of January, President Trump announced that Kevin Warsh will be nominated as the next chair of the U.S. Federal Reserve. That's a big deal because whoever leads the Fed has a lot of influence over interest rate policy, along with their team. Warsh is well known for being thoughtful about inflation and not someone markets see as aggressively cutting rates right away. That made investors reassess what they were expecting for interest rates moving forward. Interest rates didn't change immediately. The Fed actually kept rates unchanged at its January meeting, but this nomination made people rethink how quickly rates might fall in the year to come. A stronger dollar and the idea that the Fed might be less eager to cut rates weighed on certain assets. And that brings us to gold and silver. Earlier in January, gold and silver had been surging, hitting all new time highs, uh, surging as investors looked for safety or chasing returns, possibly fear of missing out. But right after the Fed chair news, both metals fell sharply. Gold and silver dropped as traders reacted to the idea that a more hawkish Fed leader and a stronger dollar could reduce the appeal of precious metals, which typically do well when people fear higher inflation or a weaker currency. So, what does this all mean for retirees? First and foremost, markets react to news quickly. There's no doubt about it. Stocks, metals, interest rate expectations all move when big headlines hit. The second is the Fed chair matters because it shapes expectations about rates, which ultimately affect everything from savings yields to bond prices. And the third is short term swings like this, what we saw in January, are exactly why diversification is so important. Your long term retirement isn't built around 1 month of volatility or headlines. So, in plain language, stocks were a bit unsettled in January, not crashing, just choppy. The Fed chair nomination shifted expectations about interest rates, strengthening the dollar and pressuring gold and silver. And while that could feel dramatic, staying focused on your long term goals is still the smartest approach moving forward. Thank you for tuning in today. Hope you have a wonderful week ahead. Also, don't forget to join us for our State of the Market presentation on Thursday, February 12th, down at the Rohan Rec Center. And that's at 2:30 p.m. Have a wonderful day.